Hello everyone, thanks for welcome back to the channel. My name is Kwan. Today I want to talk about Samsung Electronics and why the market is starting to look at this company differently. For a long time, Samsung was mainly viewed as a cyclical memory semiconductor company. When memory prices went up, earnings improved. When memory prices went down, earnings collapsed. But now the story is changing. Because of AI, memory is becoming part of the AI infrastructure story. Data centers need GPUs, but they also need massive amount of DRAM, HBM, and storage. So Samsung is no longer just a traditional memory cycle story. It is becoming an AI memory and infrastructure story. Before we go deeper, let me quickly explain two important terms: DRAM and HBM. DRAM is the basic memory used in computers, phones, and servers. You can think of it as short-term memory. When your computer opens apps, runs programs, or processes data, DRAM helps the system work quickly. HBM stands for high bandwidth memory. It is a more advanced type of memory used for AI chips and data centers. So, in simple words, DRAM is general purpose memory, HBM is high speed AI memory. That is why HBM is one of the most important part of Samsung's future story. Okay, let's start with the big picture. Samsung's 2026 equity story is centered on three things: AI memory demand, earning revision momentum, and aggressive reinvestment. The reason the stock has moved higher is not just hype. AI server has tightened memory supply. DRAM and HBM are now directly connected to the AI infrastructure build-out. In simple terms, if companies are spending more money on AI data centers, they also need more high-performance memory. That benefits Samsung. The upside case for 2026 is clear. First, Samsung's first quarter 2026 guidance was much stronger than expected. Second, public Wall Street commentary has become more constructive. Third, Samsung is planning aggressive capital spending to capture this AI memory opportunity. But there are real risks. Samsung still trades SK hynix in HBM, and in foundry, Samsung still behind TSMC. This is not only a technology issue, but it is also a business model issue. TSMC is a pure play foundry. It focuses almost entirely on manufacturing chips for other companies. Samsung, on the other hand, has many business: memory, smartphone, displays, consumer electronics, system chips, foundry, and to be honest, Samsung has like the mart, construction companies. That broader business model gives Samsung scale and diversification, but it can also make it harder to fully focus on one area the way TSMC does. So my simple view is this: the bull case is still alive as long as earnings keep improving and Samsung shows better execution in HBM and foundry. Okay, let's see the market. Samsung's stock has already had a very strong move. Based on the data in this slide, the last close was around 218 bucks Korean won. The year-to-date return was over 80%, and the one-year return was close to 300%. That is a huge rally, especially for this type of big company. So the important question is this just hype or is it just supported by earnings? In my view, this move still looks mostly earnings-led. The market is not only buying a story, it is reacting to stronger earnings expectations, better memory pricing, and the idea that Samsung could benefit from the AI infrastructure cycle. But after such a strong rally, investors have to be more careful. When a stock already moves this much, the company has less room for disappointment. If Samsung misses expectation, if HBM execution is slower than expected, or if foundry losses remain a concern, the stock can become volatile. So at this point, the market is already pricing in a better memory cycle. The next upside move needs stronger proof. And thanks to Samsung and SK hynix, Korean index is leading number one, the major world market index. Earnings. This slide is probably the most important slide in the whole presentation. Samsung's first quarter 2026 guidance changed the tone of the entire investment debate. In fiscal year 2025, Samsung reported operating profit of about 43.6 trillion Korean won. In the fourth quarter of 2025 alone, operating profit was about 20.1 trillion won. But for the first quarter of 2026, Samsung guided operating profit of about 57.2 trillion won. It's about it's about $40 billion. That means first quarter 2026 operating profit alone was higher than entire full-year operating profit of 2025. This is crazy. That is very powerful signal. This is the clearest reason why the stock was re-rated. Investors are not just hoping for a recovery anymore. They are seeing actual earning momentum. For cyclical semiconductor companies, earnings revisions are extremely important. When analysts keep raising earnings estimates, the stock can continue to perform well even after a big rally. So the key point here is simple. Samsung's re-rating is being driven by real earnings power, not just AI excitement. And so why Wall Street commentary turned more constructive? Now let's look at why public Wall Street commentary has become more constructive. According to the public summaries, Morgan Stanley reportedly raised its target price to 248 bucks Korean won. The reason was the AI memory is becoming a stronger through cycle story. This is important because Wall Street is starting to view memory differently. In the past, memory was seen as highly cyclical and risky. But now, AI demand may make the cycle stronger and possibly longer than before. Another important point is agentic AI. If AI systems become more advanced and more widely used, spending may shift not only towards GPUs, but also towards CPUs and memory. That directly benefit memory companies like Samsung. The consensus surprise also matters. The Street expected around 40.5 trillion won in operating profit, but Samsung guided 57.2 trillion won. That is major upside surprise. Also, Samsung's 2026 capex plan is more than 110 trillion won, which is like $83 billion, compared with the 90.4 trillion won in 2025. That tells us management is leading aggressively into the AI cycle. So the Wall Street is becoming more constructive because Samsung is showing stronger earnings, stronger AI exposure, and stronger investment commitment. Catalyst. Going forward, I think there are three major catalysts to watch. The first one is HBM for customer wins. HBM is the most important part of the Samsung's story right now. If Samsung can win more major AI customers for HBM4, the market may start giving the company a higher valuation multiple. The second catalyst is a DRAM price. If DRAM price stay tight, Samsung's earnings can remain very strong. Memory companies have huge operating leverage. When prices rise, a lot of that upside can flow directly into profit. The third catalyst is foundry credibility. This is where the comparison with TSMC becomes important. TSMC focuses on one core business, foundry. It became the subject matter expert in advanced chip manufacturing. Because of that focus, TSMC became the most trusted manufacturing partner for many global chips designers. Samsung is different. Samsung is much more diversified company. It makes memory chips, smartphones, displays, consumer electronics, and also runs the foundry business. That diversification is strength, but it can also be weakness. Like if when you see the one restaurant has the restaurant has only one menu, you can think that can like really good at like steak. But if the steakhouse is selling like turkey food, like Japanese food, Korean food, Mexican food, like it can be good, they can bring more customers, but also can be like a little confused. So that's the reason why the TSMC's stock price, like market cap, is twice more than Samsung. And Samsung still has something to prove in HBM and foundry. Let's be honest about the risk. Samsung is a great company, but it still has something to prove, especially in HBM and foundry. Right now, SK hynix is widely viewed as the leader in HBM for AI GPUs. That means Samsung is not automatically the biggest winner just because AI memory demand is strong. Samsung needs to prove that its HBM products can meet customer requirements, especially for major AI chip customers. The second risk is foundry. TSMC is still the clear leader in advanced foundry manufacturing. The reason is not just technology, it is also focus. TSMC built its entire identity around being a neutral manufacturing partner. It does not compete directly with its customers in consumer electronics or branded chips. And as a Korean, I think there are another issue is it's not an issue. It's good for the employees, but there is a major difference with America and Korean companies. I feel like South Korea companies, they are because of like the South Korea law, they're focusing on the labor's employees' right too much. So, for example, SK hynix had a huge earning, and they gave an average 2600% of the employees' monthly income for bonus. So if you're like making 100k, they got a like bonus like 240k. That's like more than double of like your earning. But in America, they give back to the investors and they buy back their own company stocks. So let me summarize everything. Samsung still looks more like an earning revision story than just hype story. And the company has really great fundamental, but we need to see the clear risk as well. But I still believe this company's engine is not end yet. It just started it, and as Morgan Stanley and many Wall Street Bank is expecting, I also believe that Samsung will be the #1 earning company next year. With the like current pace, it is like definitely will be. So I think it's still a very attractive company stock to invest even at this point. Thank you for watching the video.